Welcome. This next panel is about private equity meeting public markets. My name is Josh Kosman. I'm a reporter at the New York Post, and we'll introduce our panel. So maybe, Kyle, why don't you go first?
Absolutely. So Kyle Henderson here from Denver, Colorado. Flew in last night to this beautiful, beautiful town. Executive Director of Sandgard Foundation and President of Sandgard Capital. Sandgard Capital is a family office focused on private equity, capital markets, alternative investments, and international real estate investments. So one of our past acquisitions and sales includes a famous English football club. So we did our Ted Lasso thing, and we sold that for 10 times more than we acquired the club for. It was a London club, Charlton Athletic, and still fingers crossed for promotion. We're also large shareholders in Zynex Medical. Thomas Sandgard was one of our speakers earlier. So we get about 50% of the outstanding shares there, and very excited about the prospects for Zynex. One on the pain management side, and the monitoring division's got some absolute blockbuster products in the pipeline we're very, very excited about. Be remiss not to mention the Sandgard Foundation. So that's one of our biggest passions, fighting the opioid and fentanyl crisis that is just ravaging this country and caused over $1 trillion in economic damage. So we've distributed over 1 million units of Narcan and naloxone in partnership with Direct Relief and the Voices Project to sober homes, recovery homes, and hospitals around the country, track the data, and have found that over 280,000 overdoses have already been reversed, giving those people a second shot at life and recovery. And as Thomas mentioned, we have a film coming out in January called Junction that just won the Portland Film Festival and the San Diego International Film Festival, also focused on the opioid epidemic. It's not a boring documentary, it's an exciting drama, and we hope it reaches a lot of people. But thank you for having me.
That sounds like it's a great topic and great work you're doing. Mark, please introduce yourself.
That's a hard act to follow. I'm Mark Harms. I manage two businesses, Global Leisure Partners, which is a merchant bank, and Bespoke Capital Partners, which is a private equity business. Offices in London, New York, and Palm Beach, so I split my time. And we focus on a combination of private markets and public markets. I actually, for my sins, was a co-sponsor of a SPAC, which is like most of the other SPACs, trading at less than a hat size, but have learned a lot of lessons along the way. So I'm on boards of both public companies and private companies, and I look forward to a spirited debate regarding some of the positives and issues around the governance associated with those.
Sounds good. And Keith?
Sure. I'm Keith Rosenblum. I am the managing partner of Cruiser Capital. We manage 3 hedge funds. We have SPVs that are primarily invested in public companies, and we also manage accounts, which primarily take concentrated invest positions in beat-up public businesses. Earlier this year, we in a large family office bid $1.6 billion for a division of a public company to take it private, to buy it out of that company. Anyway, so maybe that's one of the relevant things I have in this panel. That and the fact that I think I'm the only panelist wearing a tie.
Sounds good. Mark, maybe just following up on that for a second, not putting you and your company on the spot, but do you think SPAC owners of companies that have some value like yours but are struggling in the markets, how many of them do you think might be open to take privates?
I would think most all of them would be. At the end of the day, if you're an investor in a public company, and if you are a fiduciary responsible for all of the investors in the public company, you have no alternative but to consider any value maximizing alternatives. So, whether you necessarily want to or not, you kind of have to.
All right. Thank you for the candor. Keith, what is your take on what we're going to see that's new because of the changing conditions in the market, as far as public-private?
I think that you have small companies, towards what Mark was alluding to. You have a lot of small companies that are capital starved and are looking for ways to grow, organic growth is going to be challenged for a lot of businesses, as it always is. Inorganic growth, the only way I think you're going to be able to grow for a lot of these small businesses is through merger. And I think you're going to see a lot more M&A to achieve scale for a lot of these smaller companies. Earlier, on an earlier panel, I made the comment that it's not uncommon to have a $100 million EBITDA business that can have $10 to $20 million of costs allocated just for the right to be a public company. So if you think about that, you're talking about a huge percentage of the enterprise value that is wasted. If you have two of those companies that then combine, you are automatically saving, let's say, $20 million, and you are creating a significant amount of value. Plus, you're enabling a larger enterprise now to access the capital markets in a way that they couldn't as a smaller company. So I think that wave will occur. And I think you see that. One of the leading indicators I learned a long time ago is look who the investment banks were hiring. And they're all hiring distressed debt bankers, you know. And so they're doing that as a way because they see what they think they see. And it's my belief that that is one of the advice that you will get as a small cap manager. Is merge with somebody and get scale.
Kyle?
Yeah, great comments. I think there's been a lot of change. Obviously, the rising interest rates have made it difficult for traditional financing solutions. Earlier this year, the first quarter is probably one of if you look at pure dollar volume, 70% of all private equity transactions in the first quarter were take privates. You know, organizations like Twitter certainly didn't hurt that figure. It's slowing down, and I think a lot of the attractive deals, public deals, are still there, and private equity still has over $1 trillion in dry powder on the sidelines, so it needs to be deployed. I think they were more risk averse, through COVID and earlier this year than they are now. A lot are coming out to look to deploy capital, and Zynex is actually a company that we're looking to potentially take private. We just recently engaged Cantor Fitzgerald for that exact reason. But you're so right. The sheer costs of just being a public company don't make sense for a lot of public companies, and when they're too small, SPACs included.
Yeah. So, what are some things that private equity firms and others should be aware of in running a small public company if they get involved? You were sharing before that unfortunately you've had shorts attacking your company, and that's part of the reason that it's in the, you're in the spot that you're in. How do you prevent that? What are other things that people should watch out for?
Focus on the fundamentals, continued growth. Zynex has had just exceptional growth over the years. Max valuation in 2020 reached about $1 billion. And we've only been rocketing since then, but the market doesn't really reflect it, which can be frustrating. Companies of smaller scale are easy to manipulate for better or for worse, specifically in a negative manner. And we've been overcoming it with good business and just stay focused on the core. It is funny because our pain management division is certainly the leader in the country. And the monitoring division, with all the products in the pipeline, poised for going through for FDA clearance. One just got approved. Investors, funny enough, want to see one or the other, but I will say Zynex is one of the only profitable companies in our peer group. So I think, again, it's focusing on the fundamentals, doing good business. Morality is important, as you touched on earlier.
Okay.
If I could jump in real quick, I think one of the big differences that exists between a private company and a public company is simple control. And when you own a company privately, you control that company, and decisions you can make. You have a smaller board that's typically more agile. You're able to do things on a quicker time frame. And I think one thing that I've seen that frustrates a lot of private equity guys in the public environment is that you don't have that ability to suddenly make things happen as quickly as you can. I don't think that that observation or problem is going to get better anytime soon. As you grow in market cap and you are included in an index, 30 to 40% of your shares are literally owned by computers. And you know, that further emboldens management teams and boards, and often emphasizes behaviors that in a private company wouldn't be tolerated for long. But in a public environment, again, it's a very different thing. In a private company, you have a much tighter, smaller board. In a larger company, you have a larger board, and maybe there's different agendas there.
Well, just to follow on that, I think that you've got much better alignment of interests typically in a private company. Public companies, a fair few of them, especially the quote-unquote independent non-executive directors, own virtually no shares.
Right.
So there's no alignment of interest with the shareholders. And that creates a problem, especially when they want to clip their $50,000 to $150,000 a year income, go to nice places for board meetings, and frankly not make decisions. And then you overlay onto that, the bar, I think, has gotten a lot higher for what is a true public company that's institutionally investable. And that used to be $1 billion. Guess what? It's not $1 billion anymore, right? It's more like $5 billion.
That's true.
And in order to get there, you have to have earnings, EBITDA of 500 million plus. There are not a lot of businesses that have those anymore. And so the bar is much higher to go public, and frankly should be much higher to stay public.
Yeah. I don't want to sit on any of your boards if you're only paying directors $50,000 to $150,000.
Just saying.
Just saying. Just saying. I'm just saying. The point is that's at the. I've never even heard of something that low. It's now like 250 to 500 for.
And that's even worse.
Yeah, I know that, and towards that whole point about the $10 to $20 million in public company costs.
Yeah.
You have 10 people on your board. It's $2.5 million right there.
Exactly.
There are 2.5 to 5 million just in, people sitting around a table pontificating.
Well, plus all of
Sorry, I didn't mean to offend everyone in the room there.
plus all of the enhanced regulatory compliance, finance, audit.
Oh yeah.
The auditors, and I think there's a fairly big push right now by the SEC to ensure that the audit community is reduced to the Big Four for public companies. And that's creating a huge burden for smaller companies that are public, frankly, ours included.
Yeah.
And it's
And when
really
you're in a public company framework, you've got your Big Four auditor, you have your Big Four prep firm to prep the auditor, you have your Big Four firm that checks your international accounts.
Yeah.
The amount of people that are touching your financials, in addition to your own financial department, that are required, is just very, very expensive.
Then you get into the audit disputes.
Yeah.
And the accounting disputes.
Yeah, and then you got to hire a consultant to resolve that.
Exactly.
Yeah.
So what would you guys advise a private equity firm or a hedge fund who is buying a public company for the first time and walking into this and maybe not knowing some of the difficulties that might lie ahead?
I've actually advised recently a very well-established private equity firm that sold a business into a SPAC, and it was a disaster, and it has been a disaster. And the things that they did not appreciate about how you deal with the public market was mind-boggling to me. I thought they were joking, actually. Little things like, well, we didn't think we needed to enter into a lockup. We didn't think that mattered. We didn't think that just selling 5% of our stock would matter, literally. And I just think it's a difference in culture. I think it's a difference in how you look at things. And I think Mark was alluding to this earlier. I actually think the trend's going to go the other way. I think that now that so many companies came public through SPACs, and there was so much attention to the IPOs, I think you're going to see it the other way. I think you're going to see a lot of public to privates, and the immediate savings there, despite the higher cost of financing, I think will accrue to those better companies.
And I would agree with that. And I also think that the private equity firms, once they've done that SPAC merger, they can be kind of stuck, right? Because no matter what happens, they're going to get sued. And so you have to be super thoughtful if you actually wanted to try and take the business private again. And typically, it's best if you aren't the catalyst of that.
And your LPs don't want that.
Correct. Yeah, because they don't want it back, right? So, that creates a whole nother dynamic.
Right.
So Mark, and I guess it's open to anybody, if that's the trend, and it makes sense that that's where we're going,
Yeah.
how do you convince, if you're selling a company to the private equity community, that, okay, this didn't succeed as a public company, how do you convince them there's an exit 3 years down the road if it didn't succeed as a public company right now?
You got to go back to the old-fashioned value creation ways, right? So organic growth, inorganic growth through thoughtful M&A and proper integration. Make sure you've got great managers. Backing the right jockeys at the end of the day is what really matters. And that's how you're going to create value. And so, and I think you're going to, it's back to frankly, the old tried and true ways.
Look at, again, back to fundamentals. There are still a lot of undervalued public companies out there that are being burdened by the governance, the regulatory costs associated with being public. And, the board nuances for sure, public boards can fire the CEO, most private ones can't. And I've seen both, right? So billion-dollar AUM private groups with virtually no board. I've seen the craziest board situations on the planet, and some public companies really got it together and others just don't. I think you're going to see a mix on both ends, but I do agree that the SPACs have, there's been opportunity there, but short-lived for many of them, and I think a lot of companies are looking to get out of the public markets.
Yeah. I mean, just to follow up on the business that I'm involved in, it's called Vintage Wine Estates. It's a winery business, one of the top winery companies in the country. And, frankly, it lost its way a little bit. They were used to operating in a low interest rate environment. It's hard to take price when you're in a 3-tier distribution system, and so your margins get squeezed. You couple that with some accounting issues, and you get absolutely plastered by the market. Now, we're treating it like a private company in a public market context. The founder CEO is now executive chairman. There's a new CEO that was brought in from LVMH, Moet Hennessy, who just started. We have a new CFO. We have a completely revamped finance and strategic planning department. We're doing all the blocking and tackling that's necessary to create value. And the hard asset value of the business is probably $4, $5 a share, and that's not where it's trading. So,
How do you deal with your debt, right? You guys borrowed a lot of money, and then you had to have you restructured it?
We did an amendment with our debt, and we've got plenty of liquidity. So, I mean, at the end of the day, that's the issue: is do you have liquidity? Because if you don't have liquidity, you are going to have a gun to your head, your back's going to be against the wall, and you're going to get absolutely nailed. Yeah. And so, whatever you need to do to create liquidity. And I think right now the banks are still doing amend and extend, amend and pretends. I don't know if that'll change more because of regulatory pressures than anything else, but my guess is it probably will. And so, there will be ratcheting pressure on these companies, and you're starting to see it in the debt markets. There's been a rash of very highly priced new issues done over the last several weeks. Companies that just had to get financing, and they're getting killed.
Yeah. And we got $500 billion in, loans that are going to be maturing very quickly, and that was very cheap money, and it ain't so cheap anymore. On the Zynex side, I mean, we've done $50 million in share buybacks because, again, we're true believers that it's undervalued, and we just announced another $20 million buyback. But I agree with you, cash is king, liquidity is so important. So we're in a fortunate place from that regard. But I think there's there's a ton of opportunity in times like these that are still out there.
Maybe, Keith, a quick question to you, and I know it's be case specific, but would you recommend to a private equity firm to make a debt investment in a company in preferred securities or converts, or would you recommend taking a company private?
You mean into a public company?
Yes.
I think I agree with what Mark was saying before. First of all, every private equity firm has its own LP base, and they have to decide what they're going to do. But look, the capital markets are alive and well in public companies, and they do. Public companies of all sizes do equity offerings every day. If if they want to take an equity offering, then they can, if they're there for the long term. Personally, I love investing in convertible preferred securities, particularly if I can get warrant kickers. The problem is, and this is alluding to what I said before, other public market investors don't like that. I don't want to buy common stock in something that has a very large convertible preferred slug on it, or that is over levered. So every action has legitimate reactions in the public marketplace. And so there are lots of other considerations. You'll hear from every public market investor, particularly small mid-cap, they want clean capital structures. That doesn't equate to a convertible preferred structure that comes in. And so there's this dance. And at the end of the day, I just, in my soul, I believe that taking them private, those businesses, is often a much cleaner solution. And, we didn't talk about things like, death spiral preferreds, which is what a private equity firm has to compete with, right? You're going to spend 500 person hours, researching a company, and then you're going to come up with a structure, and you're going to say, okay, where we're feeling comfortable is we want this preferred stock, we want a little bit of warrants here, and it's going to trigger on this type of performance, and that's fair for everybody. And the CEO goes, okay, great. And he calls up his banker or her banker, and they say, well, hey, is Hudson Bay in the room? Okay. They'll call Hudson Bay and say, hey, can you give us, or someone like them, and say, hey, can you just do a convertible preferred for us, and we'll guarantee you 10%, on their first 50 million, like they did with Bed Bath & Beyond as an example. And suddenly your 500 person hours of due diligence is wasted. And so I think that's a real problem as well. So I think the best move is to take it private. And direct answer to your question,
That was a
Doctor.
good answer. So maybe in closing, Kyle or Mark, any thoughts on how private equity as it meets public markets and where this is going?
Go ahead.
I think you're seeing this in commercial real estate, which is a pivot from what you're talking about, but preferred equity, right, opportunities. I think there's going to be a lot of private groups coming in to assist with the funding needs. Again, $500 billion and near-term loans maturing. Those are all low interest rates, and companies are going to have to get creative. And there is still a lot of dry powder out there on the private equity side. And again, earlier this year, we saw record take private figures. And I think we're going to continue to see that trend. But yeah, thank you for having me.
I think that I might disagree a little bit. I think that there is a lot of dry powder, but rates are high, spreads are even wider than they have been, substantially wider. And so pricing, therefore, has to come down. And people who were expecting to get X are now looking at X minus 20, X minus 30%. And so will they transact? Do they have to transact? And so, and we've seen this before, pricing gets really sticky, especially when it's down. And so I'd like to, with my banking hat on, I'd love to have more transactional volume, but I just don't see it for another 6 to 9 months until you start seeing rates start to come back down again, spreads start to tighten. I do business with a bunch of the biggest private equity firms in the world, people, the Apollos of this world. Mm-hmm. They're risk off right now. They don't want to write large checks. They got the money, but they're being really careful about where they're putting it. And frankly, if you are an Apollo and you can make 15 to 20% or more, frankly, buying debt instruments that have some kind of an equity kicker, you're going to do that all day long. So, so therefore the bar is very high.
Cool. Thank you for a great panel.
Amen.
Thank you, guys.
Thank you, John. Thank you, Jarrett.